Hey guys, Taylor GammaEdge here. Coming at you today with another educational piece. Today we're going to be talking about our market trend model, which is the key tool that we use in our trading toolkit to assess the trend and the momentum in the underlying market. So getting into it, have you ever watched the market rally for days while you sat on the sidelines wondering how you missed the signs? Right? Nothing worse than having FOMO. You see everyone else making money on an easy trend move higher and you are not positioned for that. Or worse, have you ever seen what looks like a strong trend only get chopped up in the sideways action? Here's a hard truth. Most traders struggle with trend identification. They rely on lagging indicators like moving averages, RSI, MACD, or confusing technical patterns that tell you where price has been, not where it's headed. Right? And all this creates a painful cycle that we've all gone through before. You enter what looks like a strong trend, only get stopped out. You sit out what seems like choppy, only to watch the market trend powerfully higher or lower. And you're second guessing yourself constantly, unsure if what you're seeing is signal or noise. The reason that you want to be trading with the trend is because with trading with the trend is like sailing with the wind at your back. It's simply easier than fighting against the headwind. While most traders agree with this concept in theory, executing in practice can be challenging. Right? Two main questions are: how do you accurately identify the trend's direction? How do you know when the trend might be changing? The root problem of all this is that traditional indicators, they don't show you what's actually happening under the surface of the market. They don't reveal real-time buying or selling pressure driving price action. And this is exactly what our market trend model does. Unlike these traditional lagging indicators that only show where a price is been, market trend model provides a window into actual market flows happening right now. This distinction is critical. It's the difference between looking in the rearview mirror versus seeing what is in front of you. So with that, we're going to spend the rest of this article, breaking down exactly what the market trend model is and how it's actionable in your trading. And so, just get more detail with that. What is the market trend model? What makes it unique? How to interpret each component of that? How to identify clear trend signals for bullish and bearish conditions, and then practical way to implement this tool as quickly as the next trading session. So getting into the specifics of the market trend model, it tracks actual transactions in the market, not just price patterns. So think about it like this, if you're only watching price alone, you're trying to predict the weather by looking at the sky. However, through the lens of our market trend model, it's like having the weather radar showing you where the exact storm systems are forming before they reach you. And again, this serves as the GammaEdge's primary tool for gauging market trends momentum in real time. What makes the market trend model unique is that it is inherently transactional, meaning that it moves with each buying and selling transaction that takes place in the market. And so getting more specific with that, the market trend model tracks the tick index, and it tracks specifically the ticks. So when the market collectively ticks up, market trend model is going to go higher. When the market collectively ticks down, the tick index in the market trend model is going to move lower. So as an example, when someone, buys shares in the market, that transaction is going to push price upward, and that would count as a single uptick. Keep in mind that the tick index is not impacted by the number of shares traded, it's just by the transaction as a whole. We have something that deciphers kind of larger from smaller orders that we'll get to in a little bit. And then coming back to this, right, when transaction pushes price down, that creates downticks. And then when we compile these upticks and downticks over time, we create a comprehensive view of market sentiment and market trend, market momentum that evolves over the trading day and over multiple days and multiple weeks. And that's one of the market trend model's greatest strengths, is that it gives you a multi-time frame point of view, all in kind of one visual. So, right, what's happening right now in the immediate term, short-term trend direction, 1 day, 1 to 3 days, and then long-term market momentum, which is multiple weeks, right? And so this powerful kind of combination helps you understand not just where the market may be headed, but how strong that tailwind behind the move has been. And so now getting into the core components of the market trend model, there are three. We have the cumulative tick, which is kind of a measure of intraday momentum. And right, this updates in real time. So in this chart, I have the tick marks down here correlated with each of these up here. So the cumulative tick, this is the bold white line here. Then we have the short-term railroad tracks, which is again right here. This is the set of 3 railroad tracks. And then we have the rainbow long-term moving average ribbon, which is self-explanatory right there. Right, and then the short-term railroad tracks, this is your 1 to 3 day trend direction, helping you understand, right, just kind of the short term. So really using the cumulative tick with the short-term ribbon is great for understanding the immediate and the kind of recent price action. And then we have the rainbow ribbon, number 3, which helps us understand what the multi-week trend perspective is. So let's now break down each one of these a little bit further. So first starting out with the cumulative tick, which again is the bolded white line. The cumulative tick is literally the tick index. Keep in mind that the tick index is an intraday metric, so we stitch, day by day together to create a time series. And so again, right, cumulative tick, backbone of the market trend model, representation of immediate buying and selling and the pressure. You can think of it like the like the market's pulse. Again, this is the white line in the visual. And from a bullish point of view, it moves from lower left to upper right, and vice versa for a bearish structure, be upper left to lower right. So again, the way that it works, every uptick in the tick index, right, that's going to push the CT higher. Every downtick is going to push it lower. Then something critical is to understand what the slope of the cumulative tick is doing. If it's kind of like this, which is a nice like 45-degree angle, this just shows sustained buying pressure throughout the session, or vice versa to the downside, selling pressure, or if it's flat, then that again, so we can kind of see up here as well. You can see the downward move. We can see a nice upward here, fairly flat here. So again, just the kind of slope and the rate of change is important as well. And again, right, we just talked about this, but trending higher, buyers are in control, trending lower, sellers are in control. Steeper the slope, the more aggressive the buying or selling is. If we see persistent buying through a session like we have right here, we call that a linear up day. And this is the strongest intraday signature that we can see. Again, and what makes the cumulative tick powerful is it's showing you what's happening right now, not 5, 10, 20 periods ago. This is a real-time view that helps you catch, strong intraday moves. It helps you also identify when trend changes are taking place, which we will get into that in a little bit. But again, just look here, we had a downtrend, and we could see that transition to a move higher. And just to reiterate a key point, that the cumulative tick slope, the slope of the cumulative tick is critical to monitor, right? The steeper upward slope means stronger buying pressure, steeper downward slope means stronger selling pressure. Next, moving on to the short-term railroad tracks. Again, that's this portion right here, the set of 3 moving average ribbons that are based off the cumulative tick itself. Right, just hit on this, and again, they're called railroad tracks because when they're properly aligned, they look like a set of train tracks, running parallel to each other. You can see that right here, those train tracks there. And so how it works, right? These moving averages tracks tend to trend over a 1 to 3 day period. When they're stacked in the same direction, it confirms short-term trend. And then, it's also to understand the relationship between the cumulative tick and the railroad tracks. Right, the railroad track's best for short-term perspective. That helps to validate the cumulative tick. When both components are trending in the same direction, you have strong confirmation of the trend. So what we pay special attention to is for bullish alignment, you have all 3 lines stacked and trending higher, with the cumulative tick trending above that as well. So that's this perfect signature right here, moving higher. Bearish is, again, these are moving lower, cumulative tick trending lower as well. And then we also have choppy price action, which kind of looks like this, where the cumulative tick is kind of starting to slice through. The railroad tracks are, kind of jumbled up as well. So you should be able to see kind of from an intraday perspective, if we have, the cumulative tick and the railroad tracks trending higher, that is strong kind of confirmation on an intraday basis like this. But also from a swing trading point of view, we can kind of see a sustained, 1 to 3 day move higher there as well. Lastly, we have our rainbow ribbon, which is our longer term moving average ribbon. It looks like that right there. And right, so this is used to kind of zoom out a little bit and understand what the bigger picture is telling us. What's important is that when we analyze the rainbow ribbon, we're specifically focusing on the red and the cyan moving averages as key reference points. The red line reacts more quickly to market changes, which is the fastest of the moving average moving average within the ribbon. Then we have the cyan line, which is the slowest and is kind of represents more of the established trend. What's important to note here is that understanding the relationship between two. So if the red is above the cyan, that is generally bullish. If it's below the cyan, that's generally bearish. And then understand what the trend of those is doing as well. Are both moving higher? Are both moving lower? Right, and so Going back to this here, we can see the cumulative tick is below these, so they're inherently going to be trending lower. So you can also kind of see how these work together so while we have the longer term, obviously trending lower in the short term, this trend has flipped. So again, that's kind of understanding of, what makes this unique about the three different time frames. We have the immediate term, the intermediate, and the long term. So kind of understanding the confluence and how all of those work together is important. And just one thing to know real quick, the long-term moving average ribbons is not necessarily critical for intraday traders, what is much more important is the cumulative tick itself and what the trend of that is doing, and then obviously its relationship to the um, railroad tracks. But all that to say, it's always best if you have the short term and long term time frames aligned. And then as a bonus, we also have something that is called the filter tick, which is this cyan line right here. What this does is this measures significant buying and selling in the market. Because remember that the tick index and the cumulative tick itself is volume agnostic. So where we start to see that is when we have significant buy ticks coming into the market. That is where this is going to start registering. So when we see this strongly moving higher, this represents that large kind of institutional like transactions are coming into the market. So this is most ideal on an intraday basis when we see a strong trending move higher, strong filtered tick that is supportive that there is real large buying behind the buying that is being represented by the cumulative tick itself. And so now that you understand the components of the market trend model, let's get into kind of a bullish structure, a bearish structure, and what a reversal structure looks like. So down below here, this is what a bullish market trend model looks like. Breaking it down real fast, just going through each of the components, the cumulative tick, strong move higher, railroad tracks, strong move higher in the same direction as the market trend as the cumulative tick. Their rates of change and the angle is supportive of sustained buying higher as well. And then it's also supported by filtered tick buying as well. Last point is the rainbow ribbon. Now that we got the cumulative tick above the rainbow ribbon, we can start to see that the red line and the cyan line are both starting to trend higher as well. Yes, I know that the red line is not above the cyan line, but we can see that both are starting to trend higher, turn higher. This is both positive. And so, right, when we have a constructive, market trend model structure that looks like this, what that means is, favorable to look for long entries, especially on pullbacks, and the probability of continuation is high. One thing to note is that the market trend model is not predictive, meaning that, just because it's a bullish structure, like we're not guaranteed to go higher, right? Like, that's an obvious statement if you've been trading for, any point of time. However, it does show momentum and this momentum on a multi-time frame basis. So as you continue to study and review the market trend model daily, you will come to understand and kind of unlock what the various components are telling you about momentum in the market. And if we have tailwinds versus headwinds, and ultimately what that means for the probability of if, price is more likely or not to go up or down. Same thing, reviewing a bearish market structure now. You should immediately see what the difference is between these two structures. Here, the bullish, here, the bearish. Be very obvious, right? The cumulative tick is trending lower. The railroad tracks are trending lower, sustained large selling via the filter tick, backing up these moves lower. So again, that should be quite obvious, and you should understand it's quite useful how to use this. So again, when we have a structure like this, a bearish structure, what this typically means is it's favorable to be in cash, looking for short entries, particularly on bounces, taking off long exposure, stuff like that, right? The probability of downside is, higher in this kind of model signature than, upside. And then, this is also helpful when we are getting a change in trend. Down here is a bullish to bearish transition. Right here, we can see that we were trending higher. Cumulative tick was starting to get above the railroad tracks, but then we saw a breakdown. This breakdown sustained, cumulative tick trending lower, railroad tracks trending lower, the rainbow ribbon, starting to trend lower as well. And then we've seen, sustained selling as opposed to sustained, net large buying via the filtered tick. And then again, showing a bearish to bullish transition. Here we can see that we were trending lower, railroad tracks lower, and then we got our change, we call it a trigger day, but right, or a reversal of the trend. Started seeing that linear up day where the market trend model, the cumulative tick was trending higher. We started to see the expansion of the railroad tracks. started to see, large filtered tick buying. So all of this was constructive to see. So right, after those two examples, it's pretty clear that the market trend model itself is providing us early warnings of major kind of moves developing, right? And so this really helps and is valuable for avoiding poorly timed entries or protecting profits on existing positions. So lastly, getting into the practical implementation of the market trend model, which by now you should feel comfortable of honestly, implementing this tomorrow if you wanted to. So the key things that we do as step one is always check the market trend model before market open. Specifically, what direction is the cumulative tick trending? Are the railroad tracks trending higher, trending lower? And what is the rainbow ribbon telling us? And is that confirming what we're seeing in the short term as well? So this initial check kind of gives us a directional bias in the day and helps us to determine what kind of trade setups we're ultimately looking for. And so again, that gets into step number two of letting it help define what your trading approach is going to be for that day. So we have the bullish market trend model, which is we're looking for setups to the long side, looking for those call dominated stocks. If you're an individual equities trader, we're avoiding to fight the trend of going short. Vice versa, with strong bearish market trend model to the downside, looking for short setups or reducing long exposure or sitting in cash. If we're trading to the short side, looking for those put dominated structures, and we're avoiding bottom fishing or trying to catch a falling knife. And then if the market trend model is choppy, if it's unclear, if it's moving sideways, that's where we want to reduce our position size, tighten stops, and maybe just consider sitting out or only taking the most highest probability trades in your system. And then step three, that's when the market is open, traders are trading, and we're looking for any intraday shifts or kind of confirmation of what we saw in the pre-market. So we want to see the market trend model, if it's trending higher in the pre-market, continue to trend higher, to continue to expand, or look for those reversal signatures. And then we also want to be paying attention to the filtered tick, which again is the large buying and selling tracker. And then it's also useful in understanding kind of for exit decisions on positions as well. Important to know, if we're seeing, the sustained move higher, then the cumulative tick starts to flatten out even, or maybe starts to slice through the railroad tracks. This is generally a good kind of take partial profit signature, or same thing to the downside. If we're moving lower, then we start to flatten and start to move higher. That's kind of a generally good sign of locking in some short-term profits to the short side, because, the market is now kind of in the short term reversing higher, or at least not going lower anymore. Here, wanted to end up with a couple common questions that we get about the market trend model. First one is, this looks too complex. I already have enough indicators. And so, our kind of answer to that is, unlike traditional indicators that add another layer of complexity, the market trend model provides a window into actual market activity. It shows you real buying and real selling, not just price patterns. So think of that like X-ray vision in the market structure, rather than just kind of a superficial technical indicator to interpret. Next one, I'm a swing trader. Why should an intraday tool like this matter to me? Our answer is, at GammaEdge, we believe that all trades start as a day trade. So getting that first day right is critical for swing trading success. You want to be automatically kind of in profits. You want it to work right away. You want to be trading with the trend, not against it. And this is exactly what the market trend model helps you do. Right? Another one, by the time I see a signal, is it too late? Market trend model excels at providing early warnings before major market moves develop. For example, you see the cumulative tick breaking through the railroad tracks, while price is still near recent higher lows. This kind of early signal gives you time to adjust your positioning before the full move develops, right? And the real value isn't just catching moves, but also preventing bad trades from showing you when conditions don't support your bias. Last one, I'm a 0DT trader, future scalper. How can the market trend model help my intraday strategy? Glad you asked. For those intraday traders, there's two powerful components that we use. I personally use as well. First is the slope of the cumulative tick. Again, is that moving sharply higher, sharply lower, indicating large buying, large selling? So in this example here, we can see on an intraday basis, this is just a one-day snapshot. We can see this is decisively lower. We also can see that the filtered tick, which is again large, measuring large buying and selling, this is moving lower as well. So, from an intraday basis, this would be really dumb to try and go long this, because there's no indication that there is any type of buying happening in this market. And right, same thing to the upside. Like we saw the reversal, then every subsequent day after that, it's just strong trends higher, seeing some filter tick buying again. Another useful way of understanding at least what side of the market you should be biased towards on an intraday basis. Then it also helps you with understanding the character of price action. If price action is choppy, market trend model is choppy, that's useful to know because participants really aren't aggressive buying or selling. But here, we're moving higher, trending higher. That's strong buying. So right, that's the information that we have for you. Now it's ultimately up to you to take action. Like we say down here, as part of the community, we offer the market trend model for both TradeStation and Thinkorswim, or you can just come in where we're streaming it every day too. So you can just watch our stream in the Discord. And yeah, I mean, that's the best way to do it. Like the community's constantly talking about the market trend model. We do pre-market notes on it. We're always posting it intraday. So you kind of know exactly what is going on with the market trend model. And just to final notes, put a bow on this. This is one of the most powerful tools we have in the GammaEdge framework, which provides us a clear multi-time frame deep dive into market momentum and trend. By understanding the interplay between the cumulative tick and the filter tick, the railroad tracks, and the moving average ribbon, you can gain a comprehensive view of market conditions that can significantly improve your trading decisions and ultimately your outcomes. But remember, successful trading isn't about predicting the future. It's about recognizing the current market environment and positioning yourself accordingly. And this is exactly what that does by in real time showing you who's kind of winning the battle between the buyers and the sellers in the market on various timeframes. So after reviewing this lesson, you should now feel pretty confident about starting to implement the market trend model as soon as the next trading session. And we are confident that you will see how staying aligned with what the market trend model is telling you can transform your trading results. So with that, hopefully this is useful. Feel free to send us an email, send us open a ticket in the Discord. We're happy to answer anything for you, or leave comments in YouTube, whatever, and we will address those. So with that, we appreciate your time. Thank you. Bye.